You are paying thousands of dollars a year for a financial product, and your insurance agent is earning a commission bigger than your monthly rent. Not because it is the best product for you, because it is the best product for them. And the worst part, you probably signed up thinking you were doing the smart thing. You work hard. You take care of your family. You do what responsible adults are supposed to do. You got life insurance. Maybe someone sat across from you at a kitchen table. Maybe they came recommended by a friend or a church contact. They showed you charts. Big numbers, tax-free growth, legacy planning, retirement income, protection and investment. It sounded almost too good. You said yes. You set up the automatic payments. And now, years later, you feel like something is off. But you cannot put your finger on it. I am going to put my finger on it for you right now. And what I am about to show you changes everything. Let me tell you about Sarah. Sarah is a registered nurse in Memphis, Tennessee. She has been working at a regional hospital for 11 years. She makes $58,000 a year. She is 34 years old. She has 2 kids, a mortgage, and a genuine desire to build something real for her family. In 2018, Sarah got a call from a financial advisor, a man her cousin used and trusted. He explained that term life insurance was just throwing money away. He said whole life was different. It builds cash value. It is tax advantaged. It is a gift you leave your children. Sarah signed up for a whole life policy. Monthly premium, $312. That is $3,744 a year. She kept paying, faithfully, for 5 years. By 2023, Sarah called to check her cash value. She expected to see real money, maybe $18,000. The number she heard was $6,200. She had paid in over $18,700. She had $6,200 to show for it. Sarah did not make a mistake. Sarah was not stupid. Sarah was sold a product designed to profit someone else at her expense. Stay with me. This next part is where it gets real. So let us talk about what actually happened to Sarah's money and what is probably happening to yours right now. The first thing nobody tells you is about the commission. When an agent sells you a whole life policy, they can earn a first-year commission of 50 to 110% of your annual premium. On Sarah's policy, that is potentially $3,700, gone before she ever earned a single dollar of growth. What schools never teach you is that the person explaining the product has a financial incentive that is directly opposed to yours. They get paid more when you say yes. They get nothing when you walk away. Meanwhile, the wealthy quietly do this instead. They separate insurance from investing. Completely, always, they buy cheap term life for pure protection. They invest the rest themselves. And the math they never show you is this. Sarah's $312 monthly premium, split differently, looks like this. $40 buys a solid term life policy. The remaining $272, invested monthly in a basic S&P 500 index fund over 30 years, grows to over $340,000. $340,000 versus $6,200 after 5 years. Let that land. Now let us talk about cash value, because this is the heart of the whole sales pitch. Your policy earns value over time. You can borrow against it. Sounds powerful. Sounds like an asset. Here is what they leave out. In the first 2 to 3 years of a whole life policy, almost every single dollar you pay goes to agent commissions and administrative fees. You build almost zero cash value in those early years. It is called the front-loaded structure. And it is not a bug, it is the design. While you were told this was an investment account, it was actually a fee extraction system wearing a nice suit. Now some wealthy people do use certain life insurance strategies. That part is true, but they use ultra-high premium, low-commission versions called private placement life insurance. You need a minimum of $1 million to even access those products. What they sell the middle class is a watered-down version that benefits the company, not you. This is not an accident. This was designed. Do not click away. What comes next is what they hide. The agent will also tell you that the cash value grows tax-free. And yes, that part is technically true. But here is what they conveniently skip over. A Roth IRA is also tax-free. And in 2024, you can contribute $7,000 a year into one. A married couple can put in $14,000 a year. Tax-free growth, no commissions, no surrender charges, no fine print. And a Roth IRA invested in a total market index fund has historically returned 7 to 10% annually. Whole life policies typically guarantee 2 to 4% internal growth after fees. Inflation alone eats most of that. What schools never teach you is that the tax benefit was real, but the vehicle they put you in was the wrong one. They handed you a bicycle and called it a sports car. Now here is where the trap gets literal. If Sarah decides she wants out of her whole life policy, she does not just walk away clean. She faces surrender charges. Most policies have surrender penalty periods of 10 to 15 years. If she cancels in year 5, she loses a significant portion of whatever small cash value she has managed to build. She is locked in. Walking away means losing money she already paid. Staying means continuing to pour money into a bad product. There is no good option. Meanwhile, the wealthy never, and I mean never, lock themselves into products with exit penalties. Liquidity is a core principle of how serious wealth is built. You have to be able to move your money freely, always. Because if you cannot leave a financial product without being punished, you are not an investor. You are a captive. Stay with me. This next part is where it gets real. Here is something that most whole life policyholders never find out until it is too late. When you die, your family receives the death benefit, but they do not receive the cash value. You read that right. You spent years building up cash value inside the policy, but when you pass away, the company keeps it. Your beneficiaries get the face value of the death benefit only. The cash value you contributed to faithfully for decades disappears back to the insurance company the moment you are gone. That is in the contract. Most people never read it. Most agents never explain it. What schools never teach you is that the cash value was never truly yours the way a savings account is yours. It was collateral held by the company, accessible only on their terms, and gone the moment you no longer needed protecting. This is not an accident. This was designed. And here is the final thing, the comparison they will never, ever volunteer to show you. An agent will never sit down and show you a side-by-side. Whole life versus term life plus index fund, side by side, over 30 years. That comparison does not exist in their sales materials. Not once, not ever. Because if it did, you would never buy what they are selling. $300 a month in a whole life policy for 30 years might produce $80,000 to $120,000 in cash value if you are lucky. $300 a month in a low-cost index fund for 30 years at historical average returns produces somewhere between $300,000 and $400,000. The difference is hundreds of thousands of dollars. That is a retirement. That is a legacy. That is generational wealth sitting on the table. And the only reason most middle-class families never see that comparison is because there is no commission on an index fund. None. So nobody brings it up. Now here is what you actually do. Right now. Today. Step 1. Pull out your whole life policy paperwork. Look for the internal rate of return, the surrender schedule, and the agent commission disclosure. Read it like someone who now knows exactly what to look for, because you do. Step 2. Get a quote for a 20-year term life policy. If you are healthy and in your 30s, that quote might be $25 to $50 a month for solid coverage. That is it. Clean protection without the trap. Step 3. Take the difference between what you are currently paying and what term actually costs. Open a Roth IRA or a brokerage account. Put it in a low-cost total market index fund. Set it to automatic and leave it alone. That 3-step move will put more real wealth in your family's hands than any whole life policy ever could. The system failed Sarah. It has failed millions of people who trusted the wrong product, sold by someone with the wrong incentives. But you are not locked into ignorance anymore. That changes today. The most expensive financial advice you will ever receive is the advice that costs someone else a commission. Most people will watch this and do nothing, but you are still here, and that tells me you are different. Subscribe to Max Wealth and let us keep going. What is coming next will change your game completely.